Aaron M. Sprecher, Bloomberg News. General Electric will exit the healthcare and oil markets as Chief Executive Officer John Flannery takes the most dramatic steps yet to pull the fallen corporate titan from a deepening crisis. The shares surged in early trading. By Richard Clough, Bloomberg News. General Electric will exit the healthcare and oil markets as Chief Executive Officer John Flannery takes the most dramatic steps yet to pull the fallen corporate titan from a deepening crisis. The shares surged in early trading. The future company will narrow its focus to power, renewable energy and jet engines, GE said in a statement Tuesday. It will spin off its medical equipment business and sell its majority stake in oilfield supplier Baker Hughes. Ad Choice Advertising and Red invented by Tees. Start your day with the news you need from the Bay Area and beyond. Sign up for our Morning Report weekday newsletter. The changes will profoundly reshape an icon of American business, which is mired in one of the worst slumps in its 126-year history amid flagging demand for industrial equipment, weak cash generation and an accounting investigation by U.S. regulators. When Flannery's done, GE will bear little resemblance to the conglomerate that used to count NBC, home appliances, plastics and a sprawling finance unit among its holdings. We are making fundamental changes to position our businesses for the future and redefine GE for another century for success, Flannery said on a conference call with investors and analysts. This is a GE that's equipped to fight for the future. Investors gave a thumbs up. The shares jumped 7.4% to $13.69 at 10:02 a.m. in New York after climbing as much as 8% for the biggest intraday gain in 3 years. GE fell 27% this year through Monday, following a 45% decline last year, a slump that led overseers of the Dow Jones Industrial Average to kick GE out of the stock gauge it had been in for more than 100 years. Tree and Fund Management, which holds a stake in GE and has a seat on the board, said it welcomed the moves. Trian supports the strategic initiatives announced today by GE and believes that these initiatives will create substantial value for shareholders, the fund led by investor Nelson Peltz said in an emailed statement. GE plans to reduce net debt by about $25 billion by 2020. The Boston-based company said it would maintain its dividend through the health spin-off. After that, GE expects to adjust the GE dividend with a target dividend policy in line with industrial peers. Payouts in healthcare are typically lower, so the combined dividend between GE and the spin-off will probably be less than current levels, Flannery said. Investors have been bracing for a possible cut as GE's condition has deteriorated. The CEO already reduced the payout in November, a painful blow to the many investors who have come to rely on the steady income. The dividend will likely be cut materially. Steve Tusa, an analyst at J.P. Morgan Chase, said in a note to clients. This is also ultimately a de facto equity raise and dividend cut when all is said and done. GE said Larry Culp would take over as lead director. Culp, a former Danaher Corp. CEO, joined the board earlier this year. Flannery's latest moves cap a strategic review he has been pursuing since taking the helm last year from Jeffrey Immelt, while effectively marking his second attempt to present a turnaround to investors. In November, Flannery unveiled changes including asset sales and a board overhaul, while saying that GE of the future would revolve around the energy, aviation and healthcare markets. That generated criticism from investors who called the steps insufficient, and the shares continued to fall. Early this year, after GE detailed worse-than-expected problems with insurance liabilities, Flannery promised to explore bigger changes, including a possible breakup. Since then, Flannery has agreed to unload GE's century-old locomotive operations. On Monday, he announced the sale of an industrial engine business to buyout firm Advent International. Immelt sold most of GE's banking on consumer operations. Under the plan unveiled Tuesday, GE will sell 20% of the health business and spin off the rest to its shareholders tax-free. The health business makes imaging machines and other hospital equipment. The exit from healthcare mirrors a similar move by Siemens, the German industrial giant that's dramatically simplified its conglomerate structure in recent years. The Munich-based manufacturer, which competes with GE in areas such as power generation and medical scanners, sold shares in its Healthineers subsidiary in March, marking the country's second biggest initial public offering in almost 2 decades. The US and European manufacturing titans have historically tracked each other's business closely, with close competition in power turbines, household appliances, medical devices and light bulbs. Siemens today is a far leaner business than it was a decade ago, having cut ties with some historic assets such as its communications business and the Osram light bulb business. GE plans to materially shrink the balance sheet of its finance arm, GE Capital, aiming to sell $25 billion in energy and industrial finance assets by 2020. The company also is exploring options to reduce its insurance exposure. GE shocked investors this year with a $15 billion shortfall in insurance reserves. The sale of the Baker Hughes stake, to occur over the next 2 to 3 years, will end GE's brief, rocky tenure in the oil and gas market. GE began an aggressive expansion of its crude operations in 2007 with the $1.9 billion acquisition of equipment maker Vetco Gray, building on a small set of assets. Over the next 7 years, GE shelled out more than $10 billion on additional deals, buying companies such as Wellstream and Dresser. Just as GE Oil. The price of crude plummeted more than 60% over 2014 and 2015. With demand down sharply, the division has weighed on GE's financial results. What's more, GE's oil field offerings were still limited compared to its rivals, constraining growth in the event of a recovery. Under Immelt, GE agreed in 2016 to join forces with Baker Hughes, creating a more formidable player with a robust product lineup that would be better able to compete with industry leader Schlumberger. That didn't last long. Flannery said shortly after taking over last year that GE would explore options to get out of its 62.5% stake, without committing to a formal exit plan. Bloomberg's Brandon Koch-Coden, Cecile Doret, Scott Devoe and Phil Serafino contributed. AD Quality Auto 360p 720p 1080p. You might also find fixed income opportunities in Asia now. Allianz Global Investors. This 29-year-old is disrupting the $72 billion watch portfolio. Singapore, 3 ways to overcome rising cost of living. Ace Pro Academy. WD My Passport. SSD, 1TB. Review. Speedy Pocket Storage. Hardware Zone. Unbreakable and unhackable during phone delays. Hardware Zone.